So Mike, could you start us out and talk, a little bit about supply and demand and just how that's so critical to really understand when you're investing, particularly in real estate development, where, new supply of some kind is going to now be available in the market from the project that you're investing in?
Well, I think the one thing that is a lesson learned in real estate development is there's a lot of lead time. From the day you identify a possible site to do a development till the day you put a shovel in the ground, till the day it stabilizes, is a pretty long runway. So the art of the deal is that the amount of supply and demand today could be quite different from 2 years from now or 3 years from now when you stabilize that property. And that's where in-depth data, experience, and really looking at the big picture as to where you think you're going to be 2 and 3 years down the road, where the supply and demand lies then is really where it's hard to predict, because what's today certainly might not be the same by the time you're ready to stabilize the asset.
Got it. Dave, what are some of your thoughts when you think about just supply demand fundamentals when you're considering making an investment in a project?
Well, I think that economics, the fundamental issue in economics is supply and demand, and that affects price. You want to produce a product at a low price and sell it at a high price, preferably. But you have to remember that that price is really determined by supply and demand. If you have a high demand for something, but also a high supply, then you don't necessarily have a high price. If you have a low demand and a low supply, same thing. What you're looking for is an imbalance between supply and demand. There's a high demand and a low supply. That's your sweet spot. So it's like umbrellas. If on a sunny day, the price of umbrellas is fairly low, but as soon as it starts pouring down rain, the price of umbrellas goes up if you're the only guy that has any umbrellas to sell. So then you've got to apply that to any other product, including real estate. So again, a lot of it is projection, and this boils down to the experience and due diligence of those actually processing the project. If you see that there's a lot of job growth in an area and there isn't a lot of new construction, that's a sign you might want to seriously consider that spot for your next project. Again, also regulators and the time to actually get this thing done. A lot of it is local regulation. Some places are a lot easier than others to get something done into market in a reasonable time. So that's a lot of it's like experience, and time is money. The longer it takes to do something, the more expensive the end product is. So it's complicated, and again, you have to rely on your professionals.
So Mike, in your experience, when considering a real estate development investment, if you see a market where there's a lot of other construction going on, a lot of new supply, planning to come online, is that a market that you'd be excited about considering an investment in, or one where you'd be more cautious than normal because you're concerned with too much inventory coming open, and then as a result pricing coming down?
It's a great question. You look across the Sun Belt markets where a lot of smart big money has rushed in over the last several years to the Phoenixes, Austins, Nashvilles, Tampa. You see a lot of this money rushing into these markets, and it's too much of a good thing at some point. At some point, I think supply does catch up to demand. And so you walk into some city and you see a lot of cranes. We used to always look at how many cranes there are in a town, and if there's a lot of cranes, then it's a boom town. But then where are you in the cycle? As every Tom, Dick, and Harry run in and put up a crane in a high rise, and so are you looking at an oversupply coming in the near future? It's really challenging to predict 2 to 3 years out. What's good now couldn't necessarily be good then. So My theory is you have to kind of play the middle ground and not get overly exuberant in good times and don't get overly conservative in bad times, but you just kind of stay in the middle of the road.
Got it. And in terms of trying to, mitigate risk, in your opinion, how does a project, let's say that's selling single family homes one by one, vary with a project, that's, let's say, building a large, single tower in terms of the ability to, kind of adapt the project's development plan to meet, the supply demand that's currently facing the market?
I think that single families, if you can phase single families, it's ideal. I remember early in my career seeing that done. Our father also did vacation second home developments, and you have the ability to phase your construction costs by building 20 homes or 100 homes at once, whereas a high rise has to all be built at once. And I think you get a lot more capital at risk of building a high rise than you do on low density single families. Yes, you have to take down the land maybe all at once, but you don't have a lot of vertical costs, which is your biggest expense usually with the single family. So I would consider it far less risk than building a high rise, as an example.